Following a pretty scary weekend in the Middle East, we see a battered Iran signals it seeks to end hostilities with Israel. Messages passed by Tehran through intermediaries seek a return to talks if the U.S. stays out of the fight. And so far today, the markets are celebrating this. You can see the S&P 500, the NASDAQ, the Russell, and the Dow Jones all making advances higher here today. And also the risk-off kind of fears that we saw causing gold and oil to move higher are now unwinding here in the opposite direction. So we have oil down, stocks up, and we have gold down as well. Bitcoin also racing back to 107,000, and the dollar index sort of stabilizing flat here at 97.8. And amazingly, on a weekly chart, the S&P 500 is very close to putting an all-time high. Markets have a fascinating way of still finding a way to go up, even when the market headlines are so scary. And this is something that can be very confusing to new investors. How can the stock market be going up, even though there's scary stuff happening in the world right now? And what's weird about it is that unfortunately there's always terrible stuff happening in the world, and yet the market finds ways to go up over time. And what I would encourage people to think about is ask yourself, does the situation in Middle East, although it is a terrible crisis and scary and loss of life is never something that we are excited about, and that's not why the market's going up, right? It's not going up because that's happening. It's just the question of whether or not the major companies within the S&P 500 are massively going to be damaged or not by what's happening in the Middle East. Is Microsoft going to seriously have huge margin cuts to its business model just because there's something going on in the Middle East? It's unlikely. And so the market can still go up even though there's terrible things happening. So it is a bit of a concept that is very foreign and weird, especially to new investors, but the markets are still operating off of the idea that inflation's cooling, earnings reports have been really strong for stocks, and for the most part, the deals in terms of trade dynamics are looking more optimistic than pessimistic like they were back here. So in my opinion, the path of least resistance for the S&P 500, for the NASDAQ, for the Dow Jones, and the Russell is further upside. And not just in the US, but I also actually took a trade on the German DAX here last week on Friday during the sell-off that we saw. I actually took the geopolitical headline scare stuff as an opportunity to buy the dip on the DAX, which is an index that I've wanted to buy for a while. Part of the reason I liked it is because the economic data suggests some upside for German stocks based on the EU economic heat map. So let me show you what we're looking at here. In terms of inflation, the ECB, I think, can continue to cut interest rates because their inflation is at 1.9%. At the same time, unemployment rate at 6.2%, while not ideal, is also not terrible. And GDP numbers actually came in better than expected. PMIs also were better than expected. So we do see some, relative to expectations, some stronger reported numbers coming out of Europe than what analysts had expected. And so to me, this suggests that the DAX, which has been leading the markets higher in general in terms of global indices, this has been doing really well already, I think is likely to continue to do well in the rest of 2025. So I bought the dip and I put a stop loss below structure. If this thing rolls over and fails out, then so be it. I'll take a small loss. But if we continue to push higher, then I think most likely we could catch a good trade here. And of course, I shared this trade within our Discord VIP group. And if you're not a member already, then don't miss our sale that we're doing right now. Every signal that I share gets sent directly to your notification box within your Discord or your desktop, your mobile, whatever. And every trade comes with a full context breakdown behind why the trade was taken, including explanations, insights, entries, exits, and more. And for a very limited time, we're doing a huge discount on memberships at this time. You can currently get 40% off if you use the promo code and link in the description down below. Also, if you have questions or you stuck through my ad here, then we're offering an additional 5% off or 45% off the total membership if you send us a direct message using the first link in the description down below of this YouTube video. Just click that link, let them know that you would like to take advantage of the 45% off offer, and they'll set you up with a membership and answer any questions you might have about what our group is and also what it is not. Taking a look at the dollar index, we are moving lower here today, so we can see back down towards those fresh lows of 2025 that we put in. And I do think that the path of least resistance for the dollar index is to continue to see this downtrend that we've been in persist. For the most part, I do think that inflation is continuing to cool in the United States. We also see some economic data showing a little bit of softness, especially the PMI data. Just take a look at services PMI, which missed big in the June 4th reported number, as well as the manufacturing PMIs also showing contraction in the manufacturing part of the economy, also missed early in June. And this week we get retail sales, so I'm very curious to see what happens with those. But for the most part, we've seen some soft data out of the US in terms of growth metrics, and we've seen inflation consistently coming in lower than analyst expectations. The red dot here is your CPI forecast, and the blue bar is what actually has showed up. And what you can see here is in the last 4 months of reported CPI numbers, we've consistently come in lower than expectations. Extending things to the producer price index, we see 3 out of the last 4 numbers coming in lower than expected, and the latest one just meeting expectations at 2.6% year over year producer price index numbers. And so I do think rate cuts and uncertainty surrounding the geopolitical landscape between all these different nations does continue to be a reason that I like the idea of buying gold. My 2 scenarios in which I'd be a buyer of gold would be a big breakout and pullback into support, or a breakdown into the 3300s to 3200s range. So in this area or in above breakout, I'd be interested in potentially buying gold depending on what the macro looks like at the time of the setup occurring on a technical basis. Another setup I like right now is oil, which is getting a very strong score within the Edge Finder at this time. And although we're seeing a pullback in the price of oil due to the headline that we started this video with Iran and Israel and all that stuff potentially taking a step backwards in terms of negotiations, right, or escalation, right, that's caused the price of oil, at least at the time of recording this, to move lower. And so for me personally, I am looking to potentially be a buyer of oil. I think the demand side for oil is strong this year. A lot of economies putting up numbers that are better than what people were expecting. And so if we continue to see oil prices shoot lower, perhaps down to the 64 level or the 61.8% retracement on this zone from low to high, I do like the idea of potentially getting long oil with a bigger term kind of picture of maybe putting a stop loss below here, which is, you know, a big stop loss. But I do think that the move for oil could also be headed back down to, you know, the low 80s. And so I'm watching oil for a pullback play if we can get it. On the currency front, I mentioned a little bit of a bearish bias that I tend to have here on the US dollar at this time. The euro looks really strong. If we get kind of a strong break and pull back into this area, I may be watching the 1.16 area or so, or this 1.15 level. If we move on to, of course, the next in the list, we have the pound dollar. I like the idea of buying the pound if you get a move back down to like 1.34. Dollar yen, I'm looking pretty neutral on this one at this time. If we take a look at dollar Swiss, leaning a little bit neutral on this one as well. Dollar CAD, I lean bearish. So if we get a retracement up into like 1.3840 or 1.4, those would be levels where I might actually look to start adding some short positions on the dollar CAD, as I do think that this one is likely to head lower at this time. And if you're looking to trade CFDs and you're outside the United States, I wanted to tell you about a really generous welcome bonus currently being offered by our sponsor here of today's video, Vantage Markets. Vantage allows traders to trade pretty much everything in one singular brokerage. And the best part is that you have all sorts of different assets. You can trade cryptocurrencies, stocks, indices, commodities through their CFD platform. They offer low trading fees, and you get a generous welcome bonus available for a limited time using the link specifically in the description of this video. So if you're interested in exploring Vantage, check them out down below in the description. Today we did a free webinar on my channel, and if you missed it, I wanted to play you a little bit of a clip here that you might find useful. If you missed this opportunity and would like to be a part of future webinars, then you can still register actually to receive the recording of the full event. If you'd like to do that, we'll leave that linked in the description of this video if you'd like to register and grab access to the recording sent later on today. In the webinar, Chris Pulver and myself both presented our ideas, bigger picture for the rest of 2025. Trade war fears seem mostly behind us. Now, it's amazing how this works in markets, right? People, when it comes to the theme, just like, you know, we as humans, we do this, right? Right now, there's always something that is, you know, really, really high, you know, impact news that everyone's focused on. And then what happens? 2 weeks later, we're on to something different. And I'm not saying that those, you know, serious things that are happening in the world right now are not serious. They are total. I'm not taking away from anything of that nature. It's just we live in this 24-hour news cycle. And by the time you get kind of all riled up about something that's happening here, something happens over here that takes everybody's focus to that. So it's a crazy world that we live in. right now there's all sorts of geopolitical tensions, but maybe the most obvious one to markets is the difficult situation that's happening in the Middle East between Iran and Israel, right? So that's a big question mark, but it's taken away the focus from all of this obsession that the markets have had in terms of coverage, in terms of headline news, in terms of everyone talking about, like, the word tariff in the first half of this year has been aggressively used over and over and over. And my personal theme or bias for the second half of the year is I think that that is mostly behind us. I think the news cycle is going to move past it. I think the markets are not going to make 3% plus moves in a day every day for a while like they did in April, right? I think that that is most likely not going to be the theme, or at least the reason, the catalyst for markets to move higher or lower as much as it was in the first half in the second half of this year. So if you're somebody who, and this is just, again, this is my opinion, I could be wrong about this, something could change, but right now, I think the path of least resistance, when we talk about the whole dynamic here, is that the tariff stuff, trade war fears, seem mostly behind us. Now, why? Well, let's think about it. A couple weeks ago, or I guess a month or so, 2 months ago, Trump was kind of proclaiming that we were going to do 145% tariffs on Chinese goods. That's scary, right? That completely shocks our system. Supply shocks, if you know much about fundamental analysis, are really scary to markets, just like COVID was, right? Or the Middle East conflict, like supply shocks to oil, supply shocks to goods and services, supply shocks to iPhones, right? Whatever it is, markets freak out about that. Well, now, when I say that this is still a potential force to watch for in markets, what I mean by that is, yes, tariffs now being kind of set at 55% are still a big change to the way our supply chain stuff works, right? Imported goods being taxed at a higher rate. But the market is less freaked out, less concerned, because we were told 145%. It's kind of like if your parents said you need to do 3 hours of homework when you get home, and you just pitched a fit and you're like, no way, that's way too much. I'm not doing 3 hours. That's ridiculous. And they said, okay, fine. Well, let's do 1 hour and then you can play your game, right? That's very like, then you're suddenly like, okay, well, I still got to do an hour of homework, but at least it's not 3 hours. It feels a lot better. And I think that that's psychologically a real thing for markets at this time. So right now, I think that you had this whole fear around, oh my gosh, we're going to get 145% tariffs and inflation's going to go skyrocketing. And now the market's like, okay, we get 55% tariffs. Is it great? Maybe not, but it certainly is not 145%. So the market rallied back, right? The market sold off on this expectation, and then we actually got this. It's kind of like if you were expecting a horrible jobs report number, and then we got a so-so jobs number. The market would like that, right? So that's happening with the tariff stuff. So I think that the path of least resistance for the trade war stuff is that it is mostly behind us at this time, unless something dramatic changes. Now, when I say these themes and biases that I have, I've learned over the years of doing this that having too strong of an opinion is a recipe for disaster. Now, what I mean by that is that I could be wrong about this. Something could flare up in the trade war that changes things and dramatically worsens. And if that happens, I'm not so arrogant that I can't say, hey, you know what? I was wrong about that and that could change. But right now, my baseline is I think most likely we're moving past the trade war stuff and we're going to start moving on to some of the better stuff that the market is excited about the Trump administration. Tariffs were not very popular, but the Trump administration also has the concept of, their tax cuts for businesses, which could make them more profitable, and things like that the market likes more, right? So the market likes less taxes for businesses because it means, they're going to be more profitable, stocks can go up, etc. They don't like so much the tariff stuff, which can cut big into profit margins for lots of businesses. So there's some good, there's some bad here. And the market, again, like I said, is mostly, I think, digested the trade war scary stuff. So that's a positive for risk assets that I want to kind of just reiterate there. The next one that is also a positive, and another reason that I remain pretty bullish for the second half of the year, is that rate cuts are still seemingly likely in the second half of 2025. I think that there is likely to be 2 to maybe even 3 rate cuts in the second half of 2025. I could be wrong about that, but the direction of rates does not seem to be moving higher, and it does not seem that we're only going to get 1 cut. It seems the market right now is forecasting for 2 rate cuts. I think 2 or even 3 is possible depending on how the data falls in the coming months. So this is obviously very stimulative. Also, it's not particularly bullish for the dollar. So how do rate cuts impact this story? Well, rate cuts are stimulative to the US dollar. To the US stock market, and they also are a negative catalyst for the dollar. So with that said, let's move on to our next theme or bias. The economy seems to be holding up decently well. And we'll take a look at some stats here in just a second. But I would say that the economy, with cooling inflation data, which has been helpful to the whole story, I think we're gonna ride the soft landing story still, right? So we're not seeing a crash in any economic data, at least at the high levels, that I think is worth panicking about, right? Jobs data has been coming in okay. Yes, it's slowing, but so is inflation. So we're likely to get rate cuts, which could save the day on that story, right? So to me, it's like you're not seeing the jobs market crash. You're seeing inflation coming down. Economy seems to be holding up well. Isn't it an amazing economy? Is it like the greatest of all time? No. But it's certainly not crashing either. So I think that that's sort of a spot where I'm like, okay, if the economy's holding up well, despite all the tariff fears, and we have rate cuts around the corner, we paint a picture where it's like, okay, this is not so terrifying. Company earnings were also a strong indicator in the first half of this year. Microsoft, Google, Amazon, NVIDIA, these companies showed up, and they showed up big despite the fears that people had due to this stuff, right? So everybody thought, many Wall Street analysts, when it comes to stock performances and company earnings calls, many people expected that this was going to negatively impact significantly the earnings projections, which are important, right? The forward projections from companies about their own earnings, and CEO confidence. They were expecting the trade war stuff to collapse everything going on in corporate America. And to the contrary, we actually had really strong earnings across most of our major companies in the United States. It was a really impressive turnout for the first half of the year. And it was it as strong as it has been in the past? No, I still think that the tariff stuff is a real concern for investors, for CEOs and people of that nature. But we didn't see the fallout that people were afraid of, and so the market is rallying back on that stance. Economies, or at the end of the day, the stock market is a market of stocks. And when we look at the indices at the highest level, the confidence that still seems there based on, company projections, earnings that were delivered, they look relatively strong compared to forecasts, which is all that matters when it comes to this stuff. We always want to be looking at what is the expectation versus what shows up. And company earnings as a collective were pretty strong. So this is the final one that I want to get into, which is tax cuts and deregulation. Now, with every administration, doesn't matter what your political background or view is, just leave that to the side for a second. With any, president in the White House, political regime, whatever, there are usually things that a market likes, and there are usually things that a market may dislike, right? So the tariff uncertainty, as I mentioned, was not something that the market liked. People said, no, that's a tax to the consumer. It can really crush things. And to the market's liking, Trump seemed to really have backed down from the really strong stance that he took on that April 2nd. When he was holding up the billboard like this, right? When he was doing all this, the market, myself included, was like, holy, we're really doing this thing. And maybe that's part of his negotiation tactic. I don't know. We're not here to get into all that. But the point is, right, he really spooked the market. The market absolutely hated that. They're like, no, that is going to absolutely derail the state of the economy, this, that, and the other. And so everybody panicked, right? And so we saw a panic sell-off in stocks and indices and risk assets in general. But then we saw the walk back. Like I said, we saw, many analysts, participants thinking that Trump kind of always tends to back down on these things, right? He says a big thing, he's a big bark, and then there's not actually the same bite to match it. And the market likes seeing that. The market's like, okay, yeah, so we're not actually doing those crazy tariffs. Okay, cool. Let's move on. And they bought the dip, right? That's what kind of happened. So then we get into the stuff that the market does like about the Trump administration, and the reason that prior to Trump winning the election, the market rallied on this concept of less taxes and deregulation for businesses, and potentially stirring up and stimulating the mergers and acquisitions part of this economy, right? Companies buying each other, companies coming public, and less less restriction on companies from buying each other can make them more competitive. If you have company A and company B, and company A wants to buy company B, but the government says, no, you can't do that, right? That prohibits company A from getting as strong. But if the government says, hey, go for it, get stronger, get bigger, and it encourages that competitive nature, company A takes company B in, and now it's a bigger and stronger company, right? So I know that was a super overly simplified version of that, but this is the concept of mergers and acquisitions. This is perceived as a very positive thing in markets. In fact, I saw something interesting, and I don't have it in front of me, but I saw something really interesting where a lot of CEOs actually cared more about the deregulation stuff and the ability to accumulate more assets under one company than they even did about the tax cuts, right? So in this case, these are the things that the market likes about the Trump administration. These are the things that the market does not so much like about the Trump administration. And so when we take a look at the holistic view, when I said this is mostly behind us and this is mostly in front of us, you can see why I'm still painting that very bullish kind of perspective on markets, and why I do think in the second half of the year, risk assets will do well. And so that is kind of the summary, the theme and bias component of this presentation on each of these stuff.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.